Hello, everyone. I would like to welcome you all with a quote given by Nelson Mandela. Education is the most powerful weapon we can use to change the world. So, ladies and gentlemen, a very good morning to all. It's my pleasure to welcome you all for the second day of our national level 5 days workshop on GST and its implication on business. On behalf of PG Department of Commerce and IQAC, in association with Chengalpattu District Branch of the Southern Indian Regional Council of ICAI, I would like to extend a special welcome to our chief guest, CA Shubhashini Ganapati. I also excited to welcome our director, Sri KB Arun, our Honorable Dean, Dr. R. Revati, our respected principal, Dr. R. Geeta Rani, our beloved HOD, Dr. J. Radha, and professors. Last but not the least, I am very happy to welcome all the audience for this national level webinar on input tax credit. I would like to invite Ms. Vasundhara to highlight the achievements of the speaker today.
Thank you, Yayani. CA Subhashini Ganapati ma'am is a founder partner of Subhashini and Associates LLP. She completed the course of International Taxation offered by ICAI. She has also completed the course on Forensic Audit offered by ICAI. Specialist is Tax Consulting, Direct, Indirect and International Taxation. She addressed CA in many forums in international taxation, tax-related topics, and accredited faculty for GST by ICAI. And she is also a motivational speaker to students community. On the part of GST side, she is accredited faculty by Institute of Chartered Accountants of India, Ministry of Skill Development, Tamil Nadu Government, and ICT Academy. She is a faculty member in DTRTI, training the income tax officers and officials of the income tax department. She also trained the GST officers on various topics. She is a co-opted member of the Research Committee of the Southern Indian Regional Council of the Institution of Chartered Accountants of India. She is a committee member of the Society of Auditors, Mylapore. She is a regular guest lecturer in many of the colleges in contemporary topics. She started an initiative with the support of a YouTube channel called RedPix 24/7, educating the general public, creating an awareness on the basics of the Income Tax Act, and now GST for Common Man, the procedures, the preliminary do's and don'ts, and the viewership has crossed 5 lakhs. She has addressed more than 15,000 students as part of the career counseling program of SIRC of ICAI and Tamil Nadu government. Apart from the educational side, she has also excelled in extracurricular activities. She is the best outgoing student both in school and college. She is a national level player in Kho, state level athlete, lyricist for a devotional album sung by Mahanati Shopana and briefing by Solvender Sukhi Sivam. She has bagged a lot of credits at state level competitions in classical dance. She has also participated in various talk shows. Undoubtedly, we are very happy for your presence in the second day of National Level 5 Days workshop on GST and its implication on business. Now, I call upon ma'am to share her knowledge on input tax credit. Please, ma'am.
Thank you so much. My special thanks to Ms. Vasundhara and Ms. Yarni for the energetic start for today's event, the national level conference on GST. I'm given the probably the core, the pivot point of GST, which is the input tax credit. So input tax credit probably like it was there in the earlier laws as well. And what is so new in the GST is what we are going to understand today in this seminar. First of all, I would like to place on record my hearty thanks to the Chengalpattu branch of SIRC of ICI and the management for this wonderful opportunity for addressing this August gathering. So coming to the input tax credit. So why is this important here? I mean, we look at the papers, the media, the news every day that there are a lot of scams around this input tax credit, because even a couple of days ago there was a scam which was unearthed by the Delhi GST officers, which was about 91 crores. So how is all this happening? And what was actually the need for even bringing in GST? So we did have a lot of indirect taxes, and as all of us know, indirect taxes contribute to the major revenue portion of our nation. So direct tax is less than 10%, and only indirect tax contributes to the major revenue of the government. Having said that, the government should definitely concentrate more on the indirect taxes. And if the government has to concentrate more on indirect taxes, it is definitely not fair on the government to put in lot of stringent measures in terms of return filing, etc., making it more laborious and making the compliance more difficult. Basically, because India as a government, as a developing country, we follow the OECD, the Organization for Economic Cooperation and Development, because that is the organization which brings in experts all over the world and analyzes the economy, gives inputs for the development, for improvement of economy, everything. So we in India as a developing nation, we follow the OECD norms, the prescriptions given by OECD, the mistakes they have learned out of their experiences is what is art. So of course, like even the GST implementation of GST, etc., we have borrowed and taken their guidelines of OECD. Now, what does this OECD say? So the OECD says we will have to make compliance easy and make non-compliance very, very difficult to develop the economy, because that culture of compliance should come in voluntarily. Because even in colleges you would have seen, like, unless there is a attendance twice, etc., then there is compliance. And especially with the online sessions these days, unless there is voluntary interest to learn, the voluntary urge to improve yourself, then there is no point in the management or anybody standing behind you and controlling. So that's exactly what the government is also following. Government is trying to bring in the culture of voluntary compliance into the people. So did government wake up suddenly about this GST to think of voluntary compliance? No. The voluntary compliance was of course there in terms of the central excise, in terms of the customs, in terms of the VAT, basically like sales tax was all state driven. So it was there in the VAT. You would have understood in yesterday's introduction about the constitutional amendment and the validity of GST, the roadmap, what the government of India went through while bringing in the GST, etc. So I'm not getting into all that. Now, why GST? So earlier there was a state law, there was a central law. Now this input tax credit basically is the mechanism which will avoid the cascading effect of taxes. So let's say, like, we were buying Boost. So we'll just look at the same Boost scenario pre GST and in GST. So pre GST, when we were buying Boost, of course, like at that time, I think it was Sachin Tendulkar. So Sachin Tendulkar was the model for Boost. There were advertisements which were aired in televisions, in radio, in print media, whatnot. So there would have been cost, there would have been service tax on all these creative portions, on creating the ad, on placing the ad on the newspaper, or broadcasting the ad in the television or a radio channel, whatever. So there was a service tax component went to it. But when it comes to this, so when we buy Boost from our local department store near our residence, we pay sales tax on that. So what happens to the service tax which was paid by the company, the manufacturer of Boost, to as a fees to Sachin Tendulkar, as for the advertisement, etc., etc. Everything went on as a cost into the Boost. So the service tax was part of the cost, and on top of that cost, there was a sales tax which was levied. So there were multiple laws and multiple inputs which were allowed compartment wise. So service tax input was available in the service tax regime under the Service Tax Act, and similarly VAT, there was input available in the VAT, but there was no cross mechanism of claiming the input, resulting which there was tax on tax. So what happened to the Boost? So we paid service tax for Sachin Tendulkar to for his time to act in the advertisements, to give posts, photo shoots, etc. That all went into the cost of the boost, and we paid sales tax when we bought the same boost in the nearby departmental store. Now, what happens in GST regime? In GST regime, whatever advertisement, etc., we pay, like if let's let it be Dhoni or Virat Kohli or whoever. If there is an amount of tax which is going into creating this advertisement, paying for the models, etc., etc., all this will not go into the cost into the boost. Instead, all the tax which is paid since the inception, right from the buying of material, right from taking the consultancy, right from whatever taxes, whatever GST you pay right from inception till the time you buy this product near your departmental store, every single rupee which is paid as taxes can be taken as input tax credit. Therefore, the result is, if a product is charged 18% GST, it is only the 18% of tax which you are paying, and there is no tax on tax mechanism. The cascading effect is totally removed. Now, why is this important to understand the input tax credit? Basically, because this input tax credit, as I told you, the pre-GST regime and the post-GST regime, the input tax credit should flow seamlessly all through the process, like be it manufacturing, be it marketing, etc., etc. It should flow seamlessly until it reaches the end customer. So there is no room for tax on tax. There is no room for cascading effect. That is exactly the objective. Now, how can this objective be achieved? So to claim this input tax credit, I'll just give you an example of how the input tax credit works. So let's say, like, Mr. A is manufacturing a product. His cost plus his profit is 100 rupees. So he has a margin, everything together, it is 100 rupees. And the tax rate, for simplification's sake, we will consider it at 5%. So his bill will be, the product will be 100 rupees. And all of you would have seen the SGST, CGST or the IGST at 5%, which is 5 rupees. So B, the wholesaler, buys it from A at 100 rupees. B adds his own margin. Let's say it is another 100 rupees. So 200 rupees is the selling price of B. So B will sell it to C, and the same 5% of tax. Here the tax amount will be 10 rupees simply because the price is 200. Now, what will be remit to the government? C will pay B 10 rupees, which is 5% on 200. B has already paid 5 rupees to A when he purchased the product for 100 rupees at 5%. So B will be paying government only 5 rupees. That is where the input tax credit mechanism works. Similarly, it follows, like, even if it is passing through 100 hands, absolutely not a problem. This will just keep rolling over, and whatever tax is collected from the other person, whatever tax is already remitted to the previous person, it is subtracted, and only the balance is paid to the government. So why can we say that GST is effective? The input tax credit mechanism is effective, apart from the fact that it has a seamless flow. It has a seamless flow, and you can take input tax credit of each and every penny you pay as taxes. So here, in the earlier regimes, we did have penalty mechanisms in service tax. We did have penalty mechanisms in central excise. We did have penalty mechanisms, interest mechanisms in sales tax as well. But if you're going to ask a question that whether this was as effective, whether the government was able to bring in or exercise control over each and every transaction, the answer is no. Basically, because it was only the officials of the tax department, the indirect tax department, who were actually monitoring the entire flow. But today, every single dealer, every single registered person in the GST is an officer himself. So here what happens when A sells it to B and B sells it to C, B makes sure that A remits this 5 rupees to the government because C has collected 10 rupees. B has paid 5 rupees to A and he is subtracting that 5 rupees. So just imagine a scenario where A has not paid this to the government, but B says, I have already paid it to A, so I will take this input tax credit, and he remits only the balance 5 rupees. What happens to that 5 rupees? So A has actually collected this, stating that this is a tax for the government, but he has actually not remitted this to the government. Instead, he has put it in his own kitty. So here B should make sure. Now there are reconciliation mechanisms to ensure that A has paid the tax, A has filed the returns, so that it is auto-populated, reflected in my books. So I need not go and tell the government that I have purchased this amount from A. It automatically reflects when A files the returns. So this reconciliation mechanism makes sure that it is a chain. So B makes sure that A pays the tax and C makes sure that B pays the tax. So every single person makes sure that their customer and their supplier are tax compliant. In fact, like when GST was brought in, there was an idea, of course, like that will be implemented very soon, that there will be a rating for the GST registered dealers. So with all this difficulty, why should I even go into the GST? I will jolly well stay outside the GST regime. I will not get myself registered. I'll still be able to do business. The answer is a big no. Basically because the input tax credit mechanism is flowing seamlessly, and if I am not into the GST regime, the person who is buying from me may not be able to take the input tax credit. So the tax which I pay, because I am now not a registered person, so I will not be eligible to take any input tax credit. Therefore, the tax which I have remitted will go into the cost of my product. So my competitor next door will be able to sell it at 5% or 8%, 18% less compared to me, basically because the input tax credit is not available to me. My tax would have gone into the cost. And for the customers are really very smart. So what do? They go and buy products only where the products are available at a reasonable price. So if the same product is available next door for 10 rupees less, obviously customers will start moving to that shop, and this unregistered person will be moved out of the business, not by the government but by the mechanism itself. So to be compliant is the only way in the GST regime, and that probably is the success of the government in bringing in the voluntary mechanism of compliance with every single dealer here. Now, who has to register? Now, registration is a separate topic as such, but only when you register, you can take input tax credit. Now, what is the difference again here between the old regime and the new regime? I mean, the GST regime. So earlier, when somebody had to do business from Tamil Nadu, let's say to Kerala, to Karnataka, to Andhra, and to all other states, the mechanism went on this way. So they had a registered office in Tamil Nadu. Then probably like they had to register their place in Kerala and Karnataka as well. So basically because when there was an interstate transaction, there was a CST levied in the earlier sales tax regime, which could not be taken as an input tax credit. So what happened? Instead of losing that 2% input tax credit, people preferred having their branches in all the states. So once you have your branches in the state, the transaction, the transfer of goods from Tamil Nadu to Andhra or to Kerala or Karnataka will be a transfer, a branch transfer, and not a sale. And the sale can be made locally from that particular state, so that the input tax credit can be availed. In GST regime, the entire supply chain mechanism went on a complete revamp. So there was no need for a business to register itself in all these states. So let's take the example of a Kanjipuram silk sari dealer who sits in Kanjipuram. So he manufactures saris in Kanjipuram and he sells. He has customers all over the country, all over the world, in fact. So for a moment, let's restrict our example to the nation, to the India. So here he can sit here in Kanchipuram, manufacture. He can sell his products all over India without getting registered in those states. Having said this, how can he sit here and do the business? If it is online, it's perfect. But if it is a kind of scenario where a person has to go there, do some marketing activity, and then come back, take the order, etc. In that case, what happens generally? When there is a transaction between the state, I mean inside the state, intra-state transactions, what is charged is CGST and SGST. So if it is Tamil Nadu, it will be Tamil Nadu state GST and the central state GST. If it is a transaction between Tamil Nadu and Kerala or Tamil Nadu and Karnataka or otherwise, the tax will be IGST. So in this case, when a person in Tamil Nadu wants to do business all over the country, I told you a registration in Tamil Nadu is more than sufficient. He need not register himself anywhere else in other states. He can be happy and do business registering himself only in Tamil Nadu. But when a person is traveling and going elsewhere, let's say to Kerala, and fetching orders from there. So if a person is staying there in Kerala, the hotel in Kerala will levy SGST and CGST. So what happens when there is a SGST and CGST in Kerala? There is a check mechanism. So for the general purpose, like it is always said, it is one nation, one tax. It's a complete borderless transaction now with the e-way bill and all that. Everything is made so seamless. So there is no border inside the country. It is completely borderless. It is the same from Tamil Nadu to Kashmir. Or Kashmir to Kanyakumari, if I had to put it that way. So it's completely a borderless transaction. But for this SGST CGST transaction, we will have to understand the tax mechanisms like it is a United States of India. I told you input tax credit is seamless. There is no tax which is getting wasted. Every single rupee which is paid as taxes can be taken as input tax credit. All that is correct. Now, when a person is staying in Kerala, so when it is related to the immovable property, the tax which will be collected will be SGST and CGST. But there is a check mechanism where Tamil Nadu state GST and Kerala state GST cannot be taken as input tax credit. So it cannot be cross-taken. So what happens to the tax paid in the Kerala state? Will it go for a waste? Again, will it go into the cost? The entire objective of GST is to make available seamless flow of input tax credit. So here again, there is a seamless flow of input tax credit with an extra little procedure which is called as input service distributor. So this input service distributor registration is what this person has to take there and take the input available from Kerala and distribute it to Tamil Nadu. So this is also applicable in scenarios, the same Boost example, where the Boost advertisement is not created in every Annachi store. No, it is created in the central head office in Mumbai or Delhi or whatever, the registered office. So here, the entire advertisement expenditure, etc., everything is managed by the corporate office in whichever place it is. So the cost is incurred there, and they, with the help of the analytics, understand when they have to place the ad on the TV, when it is appropriate to put it in the radio, when it is appropriate to put it in the paper, etc., etc. All this is done at a central level. Though whatever we see in Tamil Nadu, the advertisement comes in Tamil and Kerala, Malayalam, etc., etc. All these decisions are taken centrally. based on the TRP rating, based on the age group which is watching, etc., etc. So here what happens, the entire tax is incurred by the corporate office, and obviously there is no manufacturing activity which is happening in the corporate. So manufacturing activity is happening elsewhere, maybe in the same state, maybe in the different state. So whatever tax which is accumulated, which is paid, which is incurred in the corporate office is distributed to all the places wherever the sale happens. Now, what is the mechanism? How can this be distributed? At their own whims and fancies? So let's say like the corporate office is incurring 1 crore of taxes. So they like Tamil Nadu, so they just distribute 50 lakhs to Tamil Nadu. They don't like Kerala, they are distributing 20 to Kerala, and Karnataka is not so favorite, maybe 30 there. No, there is a scientific mechanism for distributing the input tax credit. So if there is a centrally accumulated input tax credit, it will be distributed according to the turnover. Basically, an input tax credit has to have a relevant output tax credit. So it is distributed according to the turnover. Or if it is directly incurred for some particular branch exclusively, then it is transferred directly to that particular branch. So this is the input service distributor mechanism. So for this input, for the GST registration, a person has to be registered in GST to avail the input. They have to pay taxes to the government to avail the input. They have to file returns to avail the input. And if there is a tax which is incurred outside the state, they can register themselves as input service distributor and then get the input tax credit distributed here. Now, what happens when there are additional places of business within the state? Absolutely no problem. You can either get yourself registered as a separate vertical, or if it's a same vertical, all the input tax credit can be availed. Now, this input tax credit, what are the other conditions for this input tax credit? The input tax credit should have a relevant output taxable supply. So this is an exemption. Like in the case of export, of course, this is a taxable, but for the government regulations for encouraging the foreign exchange remittances inward, etc., they have kept this as a zero rated supply. So even in that case, you can accumulate your input and get your refund. In all other cases, your input tax credit should be for the purpose of business, should directly be related to the output tax supply. So let's say like if somebody is doing a business and they are manufacturing maybe a small place, a cottage industry, they are manufacturing some pickles and poddies, etc. Now they are going to buy a air conditioner which is not required for their business, or maybe they are buying a air conditioner for their residential purpose. Can they take input tax credit on that? The answer is no. So whatever input tax credit you are taking should pertain to the business. If it doesn't pertain to the business, then the input tax credit cannot be taken, for the simple reason that any product which is enjoyed, which is supplied to the end customer, that particular product has a rate of tax in it. And if this particular cost which is gone into the manufacturing or creation of that particular product, it is important that this input credit should be available. And if you're going to spend money elsewhere, then that input credit will not be available unless it is relating to this particular transaction. To summarize, one person, if they are registered, registration is sufficient in one particular state, they can do business all over the country with all over the state with the same rate of tax seamlessly. If they are incurring any other state tax, or if they are incurring GST centrally, then they should get the input service distributor registration and distribute it all over the states, to all the states and to the dealers per se. If the person who is registered should file their returns, should remit their taxes properly to the government, then they can take the input tax credit. And the basic condition for taking the input tax credit is the input tax credit should pertain to the business. So if it is not pertaining to the business, then you cannot take input tax credit. Now we have understood the input tax credit of the normal business transactions, where I am purchasing something, I am selling something, I take input tax credit, I collect GST, I subtract the input tax credit and remit the balance to the government. So all this is understood. What happens in the case of capital goods? Let's say like I am buying a fixed asset to my company, which is for me the fixed asset is important in terms of doing the business. So I am buying this fixed asset for my company purpose. So here, can I take the input tax credit? Because earlier laws had different provisions. Let us not get into that. In GST, can I take input tax credit for fixed assets? The answer is yes, you can take input for fixed assets, but there is one condition attached to it. So if you have a fixed asset, if you bought a fixed asset worth 1 lakh rupees, and let's take an example of 18% GST, which you have paid on that fixed asset. So here, either you can capitalize your asset as 1 lakh rupees and take this 18,000 rupees as input tax credit. Or if you're going to capitalize your asset at 1,18,000 rupees, then there is no input tax credit which is available. So here, the point which we have to understand and take home is capital goods, yes, input tax credit is available, but with an option, with a condition that you should not capitalize your GST. So if you're capitalizing your cost along with the taxes, then you get to gain the depreciation benefit which you will otherwise get under the Income Tax Act. Or if you want to plan your cash flows, if you don't have sufficient input tax credit, you have an option to take the input tax credit pertaining to that particular asset, and you should not capitalize that amount of GST. You can only take, you can either take input tax credit or capitalize that and together claim your depreciation. You cannot have both. So it is either a benefit under the GST or a benefit under the income tax. Both are not available. So capital goods, GST input is available. You can choose whether you want to take the input tax credit or you can choose to capitalize it, where you will not be able to enjoy your input tax credit. Having understood the input tax credit pertaining to the goods, pertaining to the registration, pertaining to the input service distributor, pertaining to capital goods, we understood that every single amount which is going into the GST can be taken as input tax credit. Is that all? Is there something called as blocked credit? Is the government actually allowing each and every amount which is paid as taxes as input tax credit? The answer is no. There is one particular section, section 17(5), which blocks the input tax credit. But actually GST is very, very simple to understand. You have to understand only these points. But for these items, every single input is available. So if a question comes like whether input tax credit can be taken on whatever, there is only two checks which you have to do, whether that falls under the blocked credit section 17(5) or whether the input tax credit is capitalized. If the answer for these two questions is no, then the input tax credit is available. So for availing the input tax credit, you should be registered. It should be for the business. You should have filed your returns. You should have remitted the taxes. You shouldn't have capitalized this input tax credit, and it should not fall under any of the blocked credits. Now, what are these blocked credits? Anything pertaining to construction is a blocked credit. So if the input tax credit is pertaining to construction, the GST input credit cannot be taken. So if let's say like if it is a commercial complex, if somebody is building a resort, especially there is a case law out around this also. So if somebody is building a resort and the resort is built only for the purpose of letting it out, so when I let it out, obviously I will charge GST on that and remit it to the government. So when I construct, I incur so much of taxes on this construction. Is this allowed? The answer is no, because basically, of course, like there are case laws, we can take solace, comfort from that. But straight, if it is pertaining to the construction of a building, there is no input tax credit. So input tax credit is blocked in the case of construction. What happens in the case of machinery? If the machinery is attached to the earth, or if the machinery is part of the building, so if it is so very attached, like you cannot unearth the machinery and use it separately, so in that case only the machinery portion will be allowed as input tax credit, and the cost of fixing that machinery, etc. So it is all I mean, it is up to us to prove that it can be unearthed and it is movable. So if it is pertaining to the construction, if it is part of the construction, then there is a input tax credit is blocked in that case. And all other expenses like insurance in terms of food and beverage. So in terms of food and beverage, if a company is providing food and beverages to its employees, there the GST incurred on that particular transaction is blocked. The logic is GST has to be paid, remitted by the end consumer. So in terms of food and beverage, in terms of insurance, etc., there is an end customer here that is not going into the business. So that is the logic attached to it. So in case if the insurance or food and beverage, or if it is any club membership fees or any beauty parlor services, all these, the input credits is blocked. So for construction, the input tax credit is blocked, and for insurance, for food and beverage, in terms of beauty treatment services, in terms of club membership fees, etc., the input tax credit is blocked. Now, what are the exceptions to this? If there is an insurance which is mandated by the law, then the input tax credit is allowed. So this is exactly what we saw. If it is pertaining to a business, if it is essential to run your business, then the input tax credit will be allowed. So here, if it is mandated by law, then it is allowed. Similarly, in the case of motor vehicles, so in the case of motor vehicles, input tax credit cannot be availed. It is blocked except in the situations where the motor vehicle is used for transporting the passenger. So that is exclusively the business of the person to avail the passenger, I mean to provide the passenger services. In that case, it is allowed. In case the motor vehicle is used as a product of trade, a car dealer or any vehicle dealer, then that case it is allowed, because the product itself is the motor vehicle. And in the other scenario is if the motor vehicle is used for teaching, for coaching, that case the input is allowed. So the blocked credit per se are in terms of the construction. Anything which is related to the construction, the input is blocked. So when we say construction, it could be the raw material, it could be the engineer services, it could be the interior services, etc. Everything related to the construction. If you have to define the construction, any input tax credit pertaining to the construction, which goes into actually building the asset, building the construction, is blocked. Anything related to the insurance is blocked. Anything related to the food and beverage, which is given to the employees or otherwise, anything related to the food and beverage is blocked. And any input tax credit which you pay for beauty treatment services or club membership fees, etc., is blocked, because these are not pertaining to the core business activity. So in these cases, it is blocked. And in terms of the motor vehicles, there are situations where it will be allowed. So in the case of motor vehicles, it is allowed only in the case where there is a motor vehicle trade. In that case, it is allowed. In case it is for coaching, the motor vehicle is used for coaching. In that case, it is allowed, or for carrying passengers. If the core business itself is for carrying passengers, in that case, it is allowed. So in all other cases, these list of items is blocked. So as I told you, GST is very, very simple. So this, as far as the input tax credit is concerned, it is a very, very seamless mechanism. So even when you pay tax under reverse charge mechanism, so this seamless mechanism, I told you, it is all in case of the forward charge. So when somebody is paying GST to somebody, I mean, when you're purchasing goods or when you're availing the services, etc., whatever GST you pay, you can take input tax credit. There are situations where taxes are paid in reverse charge mechanism, where actually the service provider himself gets into the shoes of the service recipient and pays the taxes. For example, advocate services, lawyer services. So in the case of lawyer services, they don't pay GST, but they are liable for GST. How is this working? So if, let's say, like, I am hiring a lawyer services for my company case or whatever, and I pay him 1 lakh rupees of fees. So in this case, I will have to pay 18,000 directly to the government. Otherwise, what happens is, I pay 18,000 rupees. Let's say, like, if it is not a lawyer, if it is a chartered accountant, I will pay 1 lakh plus 18,000 to the chartered accountant and then take the 18,000 input tax credit. In the case of lawyer, I will pay 18,000 rupees directly to the government and then take the credit of 18,000 rupees. So it directly goes to the government instead of the service provider, but the input tax credit is available as soon as you remit it to the government. So whether the GST is under a forward charge mechanism or under the reverse charge mechanism, the GST input credit is available. So just again to summarize and go through the provisions of input tax credit. Input tax credit per se is a very, very seamless mechanism, to ensure that every single tax which is paid as GST is available as input tax credit. And a person should be registered to avail the input tax credit. A person should be filing the returns. A person should be paying the taxes. The input tax credit should not fall under any of the blocked credits. And finally, it should not be capitalized, and the benefit of the input should not be availed elsewhere also. So these are the conditions for the input tax credit. Now, why are we seeing so much of input tax credit related rackets which is going on, including the recent one which came in yesterday for 23 firms which actually faked the GST input tax credit, where the intelligence officers are finding it as a difficult task, and now it is part of routine, where there is a lot of input taxes which are probably like laundered around to evade tax, to actually not pay to the government and still avail and keep running the business. So this is called as goodless service, goodless invoices. So we need to have a tax invoice. The underlying documents are, we need to have a tax invoice. Tax invoice should have this component of GST and filing the returns, paying the taxes, all that we actually saw. Now, how is this fraud mechanism happening? They create firms. So, for example, the one which happened yesterday, they created about 23 firms. So 23 firms, A to B, B to C, C to E, and it just goes on and on, where only the tax invoice is moved, where there is no service or goods which is supplied, and the input tax credit is alone availed without remitting this to the government. So the entire chain was trapped, and believe me, it was 91 crores of fraud which was happening around that. Now, this tax invoice per se, like getting into the rules of input tax credit, there should be a tax invoice which follows, I mean, which is coming along with the supply, because whatever service or goods which is under the GST regime is called as a supply, and the supply can happen only along with the tax invoice. So this tax invoice is the document which we have to keep safe for claiming the input tax credit. Now all these 23 firms, the scam, etc., everything is happening around where the primary conditions for input tax credit, we say that we have to file the returns, we have to remit the taxes. Having said this, maintenance of books and records becomes very, very important in terms of the GST per se. Of course, you have that as a separate topic. I'll tell you why it is important here and why it is relevant to understand when we are understanding the input tax credit. So here, the maintenance of books per se is prescribed in all the acts. So be it earlier sales tax, service tax, or income tax act, or companies act, everywhere the act prescribes the books you have to maintain for whatever reasons. I mean, all the list of documents which you have to maintain, the number of years you have to maintain, etc., etc. Under GST also we have the similar rules for maintenance of books and records. But why is it important under GST? Because all other laws we maintain these books and records because the statute asks us to, because we say that it is important, because the government says that you have to maintain this, we just maintain it for that sake. But under GST, it is very, very important to maintain the books and records, basically because every single document, every single entry in your books, every single books you maintain is equal to cash. So unless you maintain your books properly, there will not be input tax credit which is available, and for every incorrect input which is availed. So today there is complete reconciliation mechanism and people are really struggling. Probably this is a transition phase. We should get to a place where everybody is compliant so that there is a beautiful atmosphere of seamless flow of credit. But today people are actually struggling to match the input tax credit, where I have paid it to somebody, he has not filed the returns, it is not reflecting, and all these. So for seamless availing of input tax credit, at least you can avail if you have all the documents in hand, documents in place to prove that you have actually availed the services, or you have actually purchased the goods. You have a document in hand to avail the input tax credit, and you have remitted this tax to the other person, considering him as a trustee, as an agent of the government to collect the tax and to remit it to the government. So this is about the input tax credit under GST. Unlike the earlier laws, GST provides a very, very seamless mechanism of passing the input tax credit. The input tax credit in whatever stage, however you pay, you can take the input tax credit, subject to you maintaining proper books of accounts, subject to you filing your returns, subject to you paying it to the government, and the most important condition is you being a registered person. So for availing the input tax credit, the conditions which we have to look at are, it shouldn't be a blocked credit, you shouldn't have capitalized this, it should be for the business, for exclusively for the business, and there should be a outward supply which is attached to this particular input tax credit. And with all the documents in place, we can seamlessly avail the input tax credit, provided we are into the compliance mechanism, we are following the law in spirit actually, and in records, of course. So once we start getting into the compliance mechanism, of course, this transition is definitely not easy, because there were situations where we were not so compliant, where we were not engaged, or it was not a day-to-day activity to maintain the books, to maintain every single document, to take the input, to make sure that the right amount of input is availed, or to, if there is any incorrect input which is availed, we'll have to reverse it and pay the interest due to the government. All this was not part of our routine, but today it's been like, we are touching like another 4 years now since GST has come from 2017. It's been a journey for us, a journey of transition, and today this input tax credit mechanism, the pivot point, I can say, of the GST, the crux of the GST, because that's exactly where the benefit of the GST is actually flowing to the people. Of course, we had situations where the seamless input tax credit was not passed on to the general public, etc. Now everything is getting set. We are in the transition phase. Let's look forward to a phase where it is completely seamless, where the government could implement whatever it envisaged as GST, and implementing something like this in this nation with so much of differences demographically, psychologically, socially. It is definitely not an easy task, but I think we are heading to a very, very good and greener phase for a positive economy. Thank you again for the wonderful opportunity. It was great interacting with you. Thank you. I would be happy to take any questions. 10 minutes left.
A few questions asked to us. So the first question is, sometimes goods are destroyed or lost due to various reasons. And a person can take IT to the extent of such goods.
So this goods, basically, like as I told you, it is the consumer who has to bear the tax. So in the case of goods which are lost, destroyed, so here there is no consumer. There is no person who is actually consuming, enjoying the goods to take that particular liability. And as I told you, any input tax credit should result in a outward supply. So this particular goods, when it is destroyed, lost, etc., this amount should be reversed.
Thank you, ma'am. One more question is asked by Raja Las. Whether input tax credit on motor vehicles admissible?
Input tax credit on motor vehicles is admissible only in 3 situations, where it is the motor vehicle trader himself, or the motor vehicle is used for coaching, or the motor vehicle is used for passenger transport. So if you're going to buy a motor vehicle, a car for your managing director for your company, no, it is not allowed.
Thank you, ma'am. Another question is asked by Nishantini. Whether the principal can take input tax credit of tax paid on input goods or capital goods, which are not received by him but sent directly to his job work.
Beautiful question, Nishantini. Thank you so much for this question. In fact, so here I told you, like, we need to have the tax document, we need to receive the goods, the actual transaction should be there, etc. So this is one exception to that, because in this case, practically, because GST, of course, like though being very strict in terms of the taxes, it has practically understood, and there has been like a lot of changes, but of course job worker and all were brought in the time when it was introduced itself. So let's say, like, we are in Chennai, a job worker is in Tirupur, and the customer is in Erode. So for me, sitting in Chennai, all I have to do is I have to, let's say, like, the product comes from Mumbai for some dye. So this product, if it has to come to Chennai, then I have to send it to Tirupur. All this involves a lot of hassles. So there is a concept of bill to and ship to in GST, where you can directly ship the product to the job worker, but you will be the person who is actually purchasing the goods. Though it is not physically received by you, the goods are purchased on behalf of you, because job worker is actually doing your work. The difference between a job worker and a manufacturer is, a manufacturer will work on his own products, a job worker will work on somebody else's product. So the moment we call him a job worker, he is working on my products on behalf of me. So he's more like a agent. So that case, input tax credit can be availed. And even in the cases where the job worker is purchasing it himself. So let's say, like, if I am facilitating the purchase, input tax credit can be availed. Even if the job worker is purchasing himself, he has to just make sure that the bill is to me, bill is on me, and the product is to him. The same bill to and ship to concept, input tax credit can be availed. Is there any restrictions on the period of availment of ITC? Vijay Gayatri, thank you for this question again. So when we say input tax credit is seamlessly available, Is it available eternally? So can I take, I just forgot booking a bill this year. I just discovered this bill maybe in 2017. I entered into some transaction, and today I discovered that I did not enter this bill at all. Can I avail the input tax credit? The answer is no. So you will have to avail it within the financial year, or latest 6 months from the end of the financial year. You will have to avail the input tax credit. This is applicable both for the normal goods, and in terms of the capitalization, you would have done it before the end of the financial year, because your depreciation etc. will work there. So if you want to avail, you can avail it within the end 6 months from the end of the financial year. But once you avail it, it is available in your credit ledger eternally. In terms of the banking companies, 50% of the ITC can be availed, because in terms of the banking companies, we have issues like, any financial transaction, hardcore financial transaction is out of the purview of GST. So banking per se, they render so many services. Of course, the hardcore is the interest, the financial transactions. But today it is more of other services like your credit cards, the other facilitation activities. So many services are rendered by the banking industry. So the general rule is the banking industry can avail 50% straight of the input tax credit which is available to them.
Thank you, ma'am.
Thank you.
So no more questions were asked by the viewers. Now we may go for a vote of thanks. Now I call upon Ms. Yarini to convey vote of thanks.
Thank you, Vasundhara. Ladies and gentlemen, a very good afternoon to all. It gives me an immense pleasure to deliver the vote of thanks for this event at all the dignitaries assembled here. I extend a really hearty thanks to our chief guest, CA Subhashini Ganapathy, who honored this function with his wonderful thoughts. I would like to thank our Honorable Dean, Dr. R. Revati, our respected Principal, Dr. R. Geeta Rani, our Director, Sri K.B. Arun, our beloved HOD, Dr. J. Radha, and professors. And last but not the least, our beloved audience for making this function as a grand success. Once again, I thank you, one and all present here. Thank you. I request you all to fill up today's feedback form on the comment box, and also I request all to attend the remaining 3 meetings and fill up the forms to get your e-certificate. Thank you.
Thank you so much. Once again, I would like to place on records my sincere gratitude for this wonderful opportunity provided by the Chengalpattu branch of SRC of ICI and Sri Krishnaswamy College for Women, the management and the enthusiastic team for this wonderful opportunity. Thank you so much.